The Very Good Food Company, which primarily sells its products under the Very Good Butcher brand, recently made its public debut on the Canadian Securities Exchange when they IPOed on June 18th of 2020. And what the company primarily does is they create plant-based meats and sell them through their restaurant, but predominantly sell them as packaged goods through their own e-commerce solution or through wholesale methods. So in today's video, what we're going to be doing is taking a look at this company, analyzing it from its business perspective, its financials, and as well as I'll be giving my opinion on whether I'm investing in this company or not. Welcome back to The Fire Grind. My name is Daniel, and on this channel, we talk about personal finance. We have a focus on the stock market, as I do show my portfolio on WEALTHSIMPLE, and most of my stocks on this, actually all my stocks on this portfolio, are Canadian stocks. So my primary focus is on Canadian companies, and the Very Good Food Company is another Canadian company that we're looking at today. So the format for today's video is, firstly, I'll be going over a quick overview of the company. Then I'll give a brief history, or hopefully it's brief. Next, I'll be going over the financials. Followed by that, we'll be looking at the production numbers and growth in this production. And finally, I'll be talking about my opinion and what I'm doing with the stock and whether I hold any shares. Let's dive right into it. So what does the Very Good Food Company do? So this company is an emerging plant-based food technology company that designs, develops, produces, and distributes and sells a variety of plant-based meats and other food alternatives. Their mission is to employ plant-based food technology to create products that are delicious while maintaining a wholesome nutritional profile. To date, we have developed a solid core product line under the Very Good Butcher brand. And what's interesting to me is that this company brands themselves as a technology company. And I think the technology is really coming into their ability to set up a production facility as well as do some R&D in the food space. Now let's jump over to the history of the company to give you a bit of background on the business that you might consider investing in. So let's talk about the two original founders and how they started the business. So the actual original founder is James Davison, who has a chef background and currently serves as the Chief Research and Development Officer. He started making plant-based meat products in early 2016 and selling them then. And then in late 2016, he teamed up with Mitchell Scott, who is currently the CEO of the company. And what Mitchell Scott brings to the table is that he helped to raise the early capital in the business. His experience and background really lies in small businesses, and he's done a lot in the social media and advertising space. So he really helped kickstart the company and generate sales and really build out the brand initially. So in 2016, this is really when the business started to kick off. They opened up their first vegan butcher shop, and currently this is still their only shop in existence today. And this was opened up in Victoria, BC. And on opening day, they had 1,000 people show up. And after that opening day happened, they actually had to shut down for an entire week to help replenish stock. And in August, they actually opened up a restaurant right beside the store, which serves as a place to test their new ideas. I really like this about the Very Good Food Company because they actually have their own center for testing. And this isn't like some sort of lab or where they have to pay people. They actually have a restaurant where people love to come in and try new things. And they get paid for it too. And this restaurant business has actually been fairly profitable for them. In fact, it was more profitable than their sales of their own products. Now fast forwarding to 2018, this is when they started their own production facility, which was roughly around 4,000 square feet. And for your context, think about an average Toronto apartment or any sort of large city apartment being around 500 to 700 square feet. So we're talking roughly around 6 to 8 apartments. So it's not a very big space for a production facility. And in 2019, they expanded the research team to about 4 staff. And these consist of researchers and food engineers to help their innovation of their products. And the results of this 4-man research team was the 9 products that we see on their website right now. The last highlight in 2019 is that they're tripling their production facility after signing a new lease. And this new production facility is around 14,000 square feet. And this facility won't be ready to move in until later on this year. And as of the date that they IPOed, they had 33 employees. So this company is actually quite small for a $54 million company. But management said they're going to continue expanding. And this is largely going to be production staff, I believe, because they said they're doing different shifts in their production facilities due to COVID right now. And with the new facility opening up, I think they wanted to do at least 2 production shifts, if not 3. How do they actually sell their products? They have 4 different sales channels. They have their butcher shop, the restaurant, e-commerce, and wholesale. And wholesale is mainly selling to grocery stores. And currently they have pretty high margins on the products that they sell if we're looking at the raw goods versus the sale price. Because right now the products are made from beans, natural flavoring, and some seasoning. So these are all very cheap materials. And they actually sell these products at a premium price, which further increases their margins. And they can do this because of the branding that they have. They have an artisan style branding, which is more boutique, versus Beyond Meat, which is more of like a mass market, everyday fast food. And another thing to know about their business is the subscription service that they've actually created. And typically subscription services are found in software products. However, with this company, what they're doing is that they have a subscription service that you pay into monthly and you get a box of their foods. And the subscription service ranges anywhere from $50 to $90. And right now they reported they have roughly around 700 subscribers to their meat boxes. And this yields them a minimum of $33,000 in revenue per month that is fairly predictable. And this is if they're selling the lowest tier subscription service. This number is actually likely more in the $35,000 to $40,000 range, I believe, but the company doesn't actually break down the subscription revenue. And currently they have 112 active wholesale accounts, and this includes grocery stores like Whole Foods. And they have 50 other conversations that are still in the pipeline right now, which they can convert into wholesale customers. Now turning over to the financials, the most important thing that we should look at here is the revenues, and this can be found in the income statement. Revenues have been fairly lackluster in my opinion up until March 2020, with only a growth of around 50%. Typically in small cap companies like this, I look for revenue growth around 100 to 200% because they have such small revenues, they should be able to easily double or triple these revenues over 1 year. And the reason for this low growth is because they only really started spending on advertising in this previous quarter. And they spent quite a bit on advertising. The advertising expense went way up by around 7,800%. But that's due to their aggressive online marketing through Google, as well as their partnership with the marketing company. And the partnership with this marketing company only lasted 1 month in the previous quarter. So we won't see the full effects of this marketing company until the next quarter, as this will be the first full quarter where this marketing company has been working for the Very Good Food Company. But one thing to note about the marketing company that they're working with is that the terms are not very favorable for the Very Good Food Company. It's actually probably going to cause them to lose more money in the short term because they're being charged around $60 per initial sale and 10% of recurring revenues from a single customer. So if the initial customer buys, one package of goods, that's roughly around $10 of this plant-based meat. This will generate them $10 in revenue. However, they have to pay out $60 to this marketing company that helped them generate the sales. So I see this marketing company really helping them just gain market share. Management probably knows they're going to be losing a lot of money on this. However, if they're able to capture more long-term customers that are really their champions by spreading the word of mouth to their friends and family, I think this is where they're really going to see the value from this accelerated growth. Another thing that we should look at is their margins. It seems based off of their income statement that their margins have decreased, but this is not due to the raw goods cost. This is rather due to the other expenses that are involved in the cost of making the product, such as labor and factory overhead. If we look closely into the financial statements, they roughly have a 50% margin based off of the raw goods cost to this final sale price in this current quarter, versus the previous quarter was roughly around 38%. So they've actually increased their margin. Now let's look at their fees and expenses. One of the major fees that they had to pay in this previous quarter were legal fees, and this is because the company was getting ready to go public. And as a public company, there's going to be a lot more legal fees involved, and I guess we could call these like maintenance legal fees quarter over quarter, because the company has to continue hiring lawyers to keep themselves as a public company. If we look at their balance sheet right now in terms of their cash, we can see that cash is actually quite low compared to the liabilities. And right now, their current ratio sits around 0.5. And this isn't typically great for a company because that means they have a lot less assets than their current liabilities. And this is a lot of risk as an investor going into a business with a low current ratio. However, the proceeds from their IPO are not included in this. And we can see that they raised around $4 million in funds from their IPO. If we factor this into the balance sheet, this puts the current ratio somewhere around 4.2 or 4.3. So this is actually a very good current ratio. But management did note in their statements that they actually are going to be spending around $3 to $4 million in the coming quarters on operations. So they're going to be needing a lot of these funds to help them set up their production facility and all the new equipment that they need to buy. And now turning over to the growth, which is really seeing how the production can grow over time. Currently, the company states that they produce around 7,500 pounds of product per week, but they can actually expand this production to around 20 to 35,000 pounds per week. So the ways that the company can expand their production capabilities is by including weekend shifts, expanding the number of shifts per day, so instead of one single shift, they have 2 shifts, as well as maybe they're not fully utilizing their current space, and they could bring in more machinery and more people to operate in this space. And if we look forward to the Vancouver facility, which is their 14,000 square foot facility, the company estimates they can produce around 100,000 pounds of product per week. And this is roughly equal to 5 million pounds of product per year. And if we take an average selling price of around $12 per pound, at maximum capacity, they can have revenues of $1.6 million per week or $84 million a year, with both their Victoria and Vancouver-based facilities operating at maximum capacity. So now comes to the part where I talk about my thoughts on this company, and we'll be breaking this section down into 3 different categories. I'll be first talking about the cons of this company and the risks associated with it. Then I'll be going over the pros and what I like about the company. And finally, I'll be talking about whether I have a position or planning to open up a position in this company. So starting off with the risks. So the first risk that I see with this company is that they've never generated enough revenue to cover their expenses, which means every single quarter they've had so far, they've been unprofitable. So they're burning more cash than they're taking in. On top of all this, the company currently has very limited cash according to the balance sheet, although with the recent capital raise of $4 million, that's not too bad. But one thing to note about this is that their current cash on hand with their initial public offering raise allows them only to run for 12 months. So going forward in the future, this company is either going to have to turn a profit and be able to fund their business off of their own operations or raise more capital. But likely what we're going to see is that they're going to raise more capital because this company is in growth mode. And most growth companies don't really care about the bottom line profits, they care more about capturing more market share. And that's what this company will be doing going forward, as we can see they're already burning a lot of cash. The second risk that I see associated with this company is currently there are 2 large competitors that I know of out there and probably many more. So the 2 main competitors that they have in the market right now that dominate the market are Beyond Meat as well as Impossible Foods. And Beyond Meat is currently the only other publicly traded company that is in the plant-based meat sector. And Impossible Foods will likely IPO in the next couple of years. The last risk that I see with this company right now is that they might not get the pricing power they want, and the cost of goods to create their products can fluctuate with economic demand. If there's more demand for plant-based products, we could see their cost of goods rise up. And the fact that they're small, they don't have much power over their suppliers when they're ordering goods, so they might not get the best prices out there. And this could be a slight worry going forward if they're not able to eventually turn a profit. However, when we look to their margin earlier in the financials, their margin based on the raw material costs is 50% right now. So they have a lot of room when it comes to the raw cost of their goods. They can probably find savings elsewhere as they expand, such as utilizing their production space more efficiently. Now jumping over to the pros. The first pro that I see with this company right now is if you look at their sales in April and May, they grew astronomically. Their sales in April were basically 6 times or 7 times greater than their March sales. And this was probably propelled by the pandemic, the fact that people need to cook at home and they're looking for these plant-based alternatives. So this is probably where they saw an increase in demand for their product, either through the wholesale channel or their own e-commerce channel. And when they report the next quarter, these numbers are actually going to be revealed. And we already have a sneak peek into this, and I don't think many people read this deep into their financials. So if you're watching this video and you see this might be a good time to get in, because when they report their next quarter of around $1 million in revenue, this is actually a 500% growth year over year compared to the quarter last year. And the quarter over quarter growth is 300%. And even software companies might not be able to claim this kind of growth. So I think once they report their next quarter revenues, investors are going to see this. There's going to be more hype generated around this company, and we could see the share price appreciate even more. But one thing you should note about this number in terms of the revenues done in April and May, these also include revenues from customers who have paid them up front but have not received product yet. Another pro about the company is that they have great reviews on their e-commerce website. So if you take a scroll through their products, Most of their products are sitting above a 4-star rating. Actually, all of them are sitting above a 4-star rating. So this means customers love their products and are willing to leave reviews. And typically customers who hate their products, they're more prone to write reviews. But when you're satisfied with something, you don't really want to bother to take the time to write a positive review, because really the company has already satisfied your needs and there's no need for you to, expel your happy emotions out in a review. That's at least what I find for myself. When I'm satisfied with the product, I'm less likely to write a review, versus if I hate a product, I'm going to write a review because that company did me wrong by sending me some piece of crap. And on top of all this company has found a way to get recurring revenue from the customers. So they're almost operating like a SaaS business, except they're selling a physical product. They have these monthly subscription fees to the boxes, which kind of lock customers in. And when customers are used to just paying this monthly fee for this product, it kind of makes the service a lot more sticky. And with the great reviews that this company is receiving for their plant-based meats, I don't foresee these subscribers leaving their subscription service. The next thing that I love about the company is their branding. And I think branding is super important these days. Everything from the packaging to the font, the website design, the pictures that they use, this all tells a story about the company, and basically the customers will either vibe with that or not vibe with it. I think the way this company has branded themselves is towards the younger generation who is very invested in environmentally friendliness as well as sustainability. And these are the customers that a company really wants, because younger people have a longer lifetime as customers. So the Very Good Food Company can capture younger audience and convert them into lifetime customers. This is actually a huge revenue opportunity for them, because these younger customers have at least 40 to 50 years in their life to continue purchasing. Versus if they were to target the 50-year-olds, they maybe only have 30 to 40 years left in their own life. The last thing I love about this company is that their industry is in its infancy. And what this means going forward is that the Very Good Food Company has a great chance of capturing a larger market share and being able to post numbers that are in the triple digits of growth right now. Like I mentioned earlier, they're going to post about a 300 to 500% growth year over year and quarter over quarter. So with these phenomenal numbers expected to come out over the next couple of years, or maybe even 5 to 10 years, I can see the stock price appreciating much more, maybe to the levels of $5 to $10 in the next 5 years. And this will be basically a 5 to 10x on your money. The last thing that I want to mention here about the company is that although their current valuation for a value investor is extremely rich, however, as a growth investor, I see the reward as a lot greater than the risk that I'm taking here with the company. But the one thing is, I'm not going to be throwing my life savings into this company. I think this is a great stock as a spec play. So as I talked about the production numbers earlier, showing that they produced around 7,500 pounds of product, this yields them roughly around $90,000. And if they were to go to full capacity of 135,000 pounds of product, this could yield them around $1.6 million per week, putting them at an average revenue per year of around $84 million. And with their current market cap as of filming today on June 25th, it's roughly around $54 million. So $84 million of revenue in the future is greater than their current market cap of $54 million. Although to get to this $84 million, they might need to raise a bit more capital by issuing more shares. So if they were to do a similar offering of 14 million shares somewhere down the future, where the stock price is roughly around anywhere from $1 to $2, they could raise anywhere from $16 million to $32 million off of issuing the same amount of shares as they did in the IPO. And this would roughly increase the share count by around 33%, putting it around roughly 60 million shares outstanding. And with $84 million in sales, this puts their PS ratio in the future still under 1, which makes this company very attractive still, because a PS ratio of under 1 for a growth company is phenomenal. So currently, do I hold a position in this company? Well, in fact, I do hold a very small position in this company. It's less than 1% of my portfolio. In fact, it's more like 0.1% of my portfolio right now. This is not on my WealthSimple account because you currently cannot find this company on WealthSimple Trade. So if you want to purchase this company, you're going to have to use QUESTRADE. And if you want to open a QUESTRADE account, there's a link in the description down below where you can get $50 in trade credits. So basically you can buy 10 different installments of this company to average in with this $50 credit if you really love this company. My plan going forward for this company is to continue monitoring it, and I will continue to average down on my position as it did buy in around the $1.98 mark, which is, looking back is not the greatest price because today the shares trade at around $1.19. But I think I'll be averaging in over the next couple of weeks as the price fluctuates between the $2 and $1 range. If you enjoyed this comment, please drop me a like down below, as well as if you have any questions about the company or future companies that you want me to analyze, leave that down in the comments as well. And click that subscribe and notification for more stock analysis in Canadian companies, and as well as I'll be expanding to American companies because I currently opened up a QUESTRADE account which allows me to trade in American dollars. Keep up the grind and have a great day.